Last week, Redfin CEO Glenn Kelman allegedly tried to manipulate the housing market by selling off his properties at below market prices. Since then, Kelman has announced that he is shutting down his iBuyer program completely due to the changing housing market. That was a huge mistake on his part and could mean worse for Redfin users. If you are affected by this news, you better keep watching. And if you want to see more news like this one, like and subscribe to our channel. Glenn Kelman recently stated on his blog that iBuyer is stunning a lot of money and risk for now unclear benefit, prompting the question, what's going to happen to all these houses that we wouldn't want to purchase right now? Kelman claimed in his layoff email that the housing market in 2023 will be 30% smaller than it was in 2021. Explaining why Redfin is firing off 862 talented, committed employees. Since we anticipate lower home sales in 2022, we had to lay off workers in June. Layoffs have been announced, assuming the recession will continue until 2023. Then he apologizes to the departing workers and says they don't make enough money to keep them on. Redfin's iBuying program saw much action, particularly in the Phoenix and Las Vegas areas. According to an article by Lance Lambert in Fortune, these bubbly housing markets look like buses and just sank Redfin's flipping business. Glamour distinguishes between the iBuyer programs and just normal flippers because rather than creating value by rehabilitating and selling homes, the iBuyer programs use algorithms to make speedy offers directly to sellers. The services reduce the hassles for sellers as long as the iBuyers can quickly resell the home. According to him, the company has always assured its investors that it would safeguard its balance sheet by responding swiftly. Now that it no longer had hope as a strategy, it has begun marking down its inventory. According to Lambert writes, Redfin plans to reduce its portfolio of homes to 85 million by the end of January 2023. And to sell all of its homes by the end of the second quarter of 2023 at a discounted price, which will accelerate the home price correction drama automatically, where they own many homes whenever you have a large influx of homes coming on the market at the same time at a discount. Research by Rick Palacio Jr. at Johns Burns Consulting found that iPurchasers and other investors who surged into the market during the boom are helping to drive down property prices faster this time. He has already admitted that he prices his homes 2% lower than the last lowest comp and immediately reduces the price again if it doesn't sell in the first weekend. As I said last week, this is good news for buyers who have been priced out of the market because hopefully there will be more inventory coming on the market at a discounted price. But bad news for homeowners and sellers. Lambert reports that as of the end of October, inventories were up 33% year over year, but that the increase was much more apparent in bubble markets where iPurchasers were vulnerable. Before we continue, why don't you hit that like and subscribe button? That is one good way to show your support for Stockology. This way, we can continue to provide you with quality videos. And without further ado, let's continue the discussion. Phoenix has seen a 173% increase in active listings for sale on Realtor.com over the past year, while Austin and the Salt Lake City have seen increases of 136% and 107% respectively. He uses the sale of a 3-bedroom home in Las Vegas that Redfin purchased for $600,000 in April to illustrate the market's correction in that city. Lambert adds that even after all these aggressive price cuts, iBuyers still have a significant amount of inventory to offload in those buoyant marketplaces. As pressure mounts on iBuyers to unload their position additions, they are likely to become more aggressive in pricing. This will continue the downward spiral until prices reach a point where demand enters to stabilize them. iBuyers still own around $1 billion in units, and their sales transactions accounted for 10% of all Phoenix sales activity in September. According to Jason Lewis, a co-founder of Parcels, all the circumstances are there for a housing crisis in Phoenix. So perhaps those purchasers who were priced out of the market for the last 2 years could now be able to afford a home if prices go low enough, even with the higher loan rates. Phoenix and Las Vegas, where there is a large concentration of potential buyers, seem poised to experience the greatest price declines. Check out Redfin's recent housing market update for the most recent stats on the current state of the property market. 30-year mortgage rates rose to 7.8% in a report issued on November 10 for the week ending November 10. This week, I've seen rates as low as 7%, but interest rates fluctuate daily. So, we'll have to see what happens. Google searches for houses for sale are down 28% from a year ago, but they are up 1% from the previous week. Attendance at churches is down 29% from a year ago, but it is up 1% from the previous week. Pending home sales are down 34% from a year ago, the largest annual decline since January 2015, the earliest monthly data available. This is the time of year with holidays when new listings are going to be lowered, as you can see both in 2020 and 2021, but we are comparing the same time of year this year to last year. So, we're still way lower than we should be active listings. Months of supply. The balance between supply and demand calculated by dividing the number of active listings by closed sales was 3.3 months, the highest level since June 2020. The number of homes listed for sale at any given time during this period was up 10% from a year earlier. Homes that sold were on the market for a median of 35 days, up over a week from 27 days a year earlier and up from a record low of 17 days in May and early June, since properties remain on the market for longer than ever. It's evident that an unprecedented 7.9% of listed prices will need to be lowered. Price reductions averaged 3.6% each week, up from 2.4% a year ago. Yet, there is still a severe shortage of homes in need of price reductions. The market needs to be corrected for buyers to enter. This is the lowest level seen since July 2020 for the average sale-to-list ratio, which evaluates how close homes sell compared to their final asking price. Therefore, if just about 8% of properties are dropping their prices and homes are still selling at 98.7% of the list price, that is what I can reduce from this. Either property sellers are pricing their properties more realistically, or there is a surplus of available homes causing prices to fall. In the following months, it will be interesting to observe how Redfin's decision to unload its $350 million worth of properties for sale affects this data. Meanwhile, let us know, is Redfin a significant player in your area? And if so, are there a lot of Redfin listings, or are there more inventories? To what extent are you still getting multiple offers? Leave a comment below and let us know what the housing market is like where you live. It will help us get a better overall picture. I hope that today's video was helpful to you. If you found this video helpful and would like to express your appreciation, please hit the like button. Leave a comment and consider subscribing to Stockology. I value your time, so thank you for watching.